welcome to the CNbc TV 18 special. I'm Shireen Bhan, and my guest today is now the Managing Director and Global Head of Local Markets, Rates and Treasury at Citi. Pankaj, Vaish, good to have you back in India, and thanks very much for joining us on CNbc TV 18. So it's been quite a journey for you from India to Mexico and now to London in your new global role. What's this whirlwind meant for you?
Thank you, Shireen. It's always a pleasure to be with you. It's been a lot of fun, quite honestly. I had a wonderful time in India. In Mexico, we own a very big bank, Banamex. So my seniors had asked me to go and sort of turn that around. And then in London, the role is a global role to look after all emerging markets, rates business. We are in about 75 countries. So it's a lot of fun. It keeps me intellectually stimulated. I think all the learnings I have from India and Mexico, and previously I worked in New York for 17 years, have been very helpful in, when I meet the People's Bank of China or when I meet the Russian Deputy Minister of Finance, I can give them examples of what some leading emerging markets have done. And they're always very keen on that. The PBOC is very keen on what India is doing, what RBI is thinking. The Russians like the analogy of what Brazil or South Africa is doing. The Turks the same. So it's just very interesting to be able to cross-mingle ideas and give the best of ideas to other countries. That's fun. That's a lot of fun. And I think it sort of helps the countries because they get to hear what they're thinking at some of the leading central banks and governments.
So I'll talk to you about EMs in just a bit, but let me ask you about what you see from your vantage point as far as the big global growth engines are concerned. And let's start talking about the US. A rate hike by the Fed in December, at least consensus on the street is that there will be a hike. And the Fed commentary seems to suggest that there'll be 3 in 2018. You believe that the market seems to want to believe otherwise. But what's your take on what the Fed tightening is actually going to mean for flows into emerging markets?
So just on the Fed, they are dying to hike more than what the market believes. They, in fact, 2-3 weeks ago, the market was building in no tightening till the beginning of 2019, which the Fed, I think, was sort of taking a little bit of insult at just, why don't you trust that I'm telling you I'm going to admonish you if you don't behave? So it was a very strange kind of a setup. North Korea tensions was a part of it, but still. Now the market has priced in the very high probability of a hike this year. But the Fed is saying 3 more in 2018. The market does not believe them. They just don't think they will have the wherewithal to do it.
But you believe that they will?
I am more on the Fed camp. Maybe it's not 3, maybe it's 2, I don't know. Maybe the weighted probability will settle somewhere around 1.5. But there is room. Unemployment rate is low. And while inflation has not picked up, I believe the Fed just wants to have enough gap so that if there is a synchronous global slowdown, they have enough room to come down. And frankly, 50 basis points here or there does not make that much of a difference in today's US economy because the leverage ratios are not that high. Most balance sheets are pretty clean. Given the tightness in the labor market, it's probably okay, as some of the Fed governors are suggesting. So I think they have an argument there. The ECB also is trying to hike, at least they're trying to initially start with the tapering of the balance sheet. So the 2 big banks out there are telling us that they want to contract a little bit the extraordinary stimulus that's been given. And I think it's good to listen to the people who control the levers, what they're about to do, and you sort of ignore them at your peril. So I think it's fine. At the Fed, as you probably know, that 5 out of 7 seats will have to be filled by President Trump. And that's the big question mark. What kind of people he'll put in there. The big one is the Fed chairman. There's a lot of names that have been floated about.
Are you in the camp that believes that Yellen will return?
No, I think the probability of that is low. I think it's not 0, but maybe it's in the order of 10% or something. But I think President Trump seems to have shown us in all his appointments he's wanted to put his person in there, the person who will adhere very strongly to the line that
That's
the
not
agenda.
Unusual. We're seeing it happen everywhere in the world.
I guess that's a prerogative of being an elected leader, right? You want to put in people in seats that will do the agenda that you want to dictate. So I think that's fair. And I think he will want to put a fresh person. That's what it sounds like right now from the political pundits we talk to who are very close to the Washington machination. So the names that we are hearing, I think they're all very competent names. Kevin Walsh is there, Glenn Hubbard. So I think these are all people who were sound monetary people who maybe a little bit John Taylor, who are talking about that rates are a little bit too low, that the Fed's been a bit too accommodative. So if any of these people come in, there could be an initial sell-off in the US fixed income market and thus in the global fixed income markets. But it'll probably be limited because there is a limit to how much the Fed can hike. So I think there'll just be some limited sell-off, including in major EM countries. In the bond market. So rates could go slightly higher.
It's interesting that you talk about how the two major central banks are looking at contracting the stimulus. And here in India, the buzz is around bringing back a stimulus to try and ensure that the economy gets a helping hand, so to speak, if I could use the language that's being used by people in power today. What do you make of that?
So do you mean the stimulus on the government side or the monetary?
Monetary as well, because the clamor here in North Block as well as in corporate India is that the MPC should do at least 100 basis points.
So let's separate the two. I would say on the fiscal side, given how bad the budget deficit outlook seems to be for fiscal year to date, there's probably very limited room of what the government can do. They'll want to keep an eye that the fiscal deficit doesn't get too out of control. A 0.1 or a 0.2 overbreaching is probably okay by global measures, but anything beyond that, I think rating agencies and global investors will start questioning. So far, they've had very good discipline. So far, they've also had good luck with the rains that food prices and crude, right? So far, everything has lined up quite well on the fiscal side. And I think there's no reason to ruin that at this stage because the government actually has a fair amount of credibility with global investors. So there's no reason to, I think, to tamper with that. On the monetary side, what I can say is that I know when I was leaving India, I was talking about that the RBI will take the scenic route, but will eventually get there. And I think they've eventually gotten there after a lot of analysis, a lot of hand-wringing. I think they've eventually gotten to the rates much closer to where they belong. But I saw, even in the process, there was a lot of worrying about many different things. New topics would keep getting put on into the pot of things to worry about. But globally, inflation has collapsed. And so
you believe that fear is exaggerated? I mean, the government's argument is, and the chief economic advisor has publicly stated this several times over, that look, the RBI has got it wrong on its inflation forecast, not once, not twice, but several times over. And hence, the government believes that there is a very strong case for an aggressive rate cut.
So in fact, when I was leaving India about a year and a half ago, I remember there was a chart I used to show that even though RBI talked about being in 150 to 200 basis point real rates, because their forecast of inflation was incorrect, and by the way, every central bank around the world got it wrong, including the Fed. So RBI is not alone in that. But given that the inflation forecast was just incorrect, ex-post real inflation, at least a year and a half ago for the prior 3 or 4 years, were more like 400 basis points rather than 150 to 200. So India has run a tight monetary policy, if you look at it in an ex-post analysis, versus what they have been aiming for. And now I think cyclically it becomes a little bit harder. I think 100 basis points is very difficult to do because let's say inflation bounces to 4, slightly over 4. You can't cut to 5% right now because then your real rates are too low. Plus, the fiscal deficit noise, plus the current account coming back a little bit. I think now is not the good time to be able to do 100 basis points.
How much do you think they have the room for?
I think it'll be very data dependent. I think we'll just have to see how much the inflation bounces. Does it just go to 4.2? Does it go towards 5? Or it goes to 4.2 and then comes back down to 3.5? I think if it comes down to 3.5, then you could probably argue for a 5% policy rate. But if it doesn't, then I don't think that room is there. In some sense, by being very tight and somewhat hawkish, I remember at one stage, if I'm not wrong, someone even talked about a preemptive policy hike.
Yeah.
So by being that hawkish,
Yeah.
I think the window's sort of slightly missed by how much could have been done. But that's plus or minus. That's for policymakers to decide. I can just tell you from a global point of view, sitting far away, most investors think that India has done a good job in terms of staying a little bit on the hawkish side, but that tends to reassure global bond investors. And they're not very nitpicky about 25 basis points here or there. From a corporate India point of view, I can understand their concern. And so I think there is still room to cut rates more. But just very short-term cyclically, this is a little more awkward of a point to be aggressive than last 12 months. I think there was or last 18 months, there was a much easier opportunity.
So given the context that we're speaking in, and from a global bondholder's perspective, what would be the key concerns then? I mean, you spoke of the fact that if there is a breach on the fiscal deficit by 0.1 or 0.2%, that would still be okay, but anything more than that would perhaps get the alarm bells ringing. But outside of veering away from the path of fiscal consolidation, what else would worry global investors today?
Well, Shireen, from equity markets, the problem also is valuation. Valuations are pretty high, and I think our India strategist says the same thing. So I'm not saying something out of consistency with our house view. If you look at Indian equity index overall, or the banking sector, or the mid-cap sector, those valuations are very high. I think by some measures are even much higher than 2007 and 8. So that kind of concern is valid for global investors to say, let me just take some profits, let me shave my exposure a bit. But what I'm told is that finally the Indian household money into equity market phenomenon is taking place.
Yes, look at the flows into domestic mutual funds.
This was something, Shireen, for 5 years when I was in India, I used to keep thinking, when will this happen? Because the percentage of equities in a household balance sheet was so low by global standards, and also by an EM standard in the phase of recovery that we were. It used to surprise me. So I think finally it's happening, and that's the money that's coming in. Unfortunately, it may be coming in at a little bit high valuation. So I hope these householders will stay for 10, 15 years. But global investors are not turning negative on India. They just feel it's fully priced. Yeah. Even the Indian rupee is fully priced. And so, at 63.5, they just didn't see how much more you could do, especially when RBI is not looking for it to appreciate too much. So that's just the view. I think global investors are just saying, I've made my money. I think the market is fully priced. Let me just stand back. There may be a better entry point, I can re-enter at a better opportunity. And that's all. I don't think people are turning negative on India.